Hi, it's Frank from CappThesis with a market update here for Tuesday, September 19th, 2023. And so the S&P comes into Tuesday after logging one of its smallest moves of the year. We know that. And as noted last evening in a report to clients, the back and forth trading session left really both sides looking for more. Right? It failed to satisfy bears who were hoping for immediate downside follow through after Friday, and left bulls hoping for a better snapback effort as well. So naturally, then very little has changed on the key S&P 500 charts that we've been watching, like this one. So the index once again finished near the breakout zone of the small bullish pattern. Now we know this can't last for much longer, especially with the FOMC decision and a commentary tomorrow. That said, it's always interesting to see how a certain price level can act like a magnet over a certain period like this. And I would say that a few others were staring at this 44.55 zone when we first pointed it out at the breakout point back on 829, but a lot of traders now have it on their radar for sure going forward. And so the triangle pattern got even tighter. And based on the number of comments I received after putting this chart on X or Twitter yesterday, traders seem divided on which way it will break. And as noted before, patterns like this are enticing, especially when the lines are this symmetrical. But oftentimes it just becomes part of a bigger formation that is yet to be constructed, right? So this could actually persist for longer, even after we see a break to one side or the other. So the potential bullish and bearish patterns that we've been talking about both remain in play ahead of the Fed as well. This is clearly could be one substantial bullish cup and handle pattern with eventual break above the, say, 44 or 45.50 zone. And on the downside, this double top light pattern, if you want to call it an inverse cup and handle as well, sitting right above 44.25. So in two big patterns potentially in play as the Fed is right on deck here. And so another thing we've been watching recently is the anchored VWAP for spiders, and attached to the most pertinent highs and lows recently, we can see that starts the day below all of them. So that's obviously a risk. We want to eventually see a break above back here. Again, I wouldn't take too much from it with the Fed tomorrow, but this is obviously a key zone to eventually get through. Now, in terms of breadth, oftentimes we can detect divergences in breadth, positive or negative. I would say that this is not one of those times. We can see how similar the S&P and its cumulative advanced decline now look to one another. Both remain below the July highs, but above the August lows right now. So, we hear a lot about the mega caps leading or lagging or dictating the action, but really it appears right now from a breadth perspective that it's pretty much in line with the index. Now, turning to 52-week highs, one thing we'll definitely need to see improve from here is the number of new highs in the market. And it doesn't have to happen right now, given that most stocks still, again, remain below the highs from summer. But if the S&P can right itself and actually make a new 52-week high again soon and go above those July highs, seeing many of its components do the same clearly would be helpful. That's obvious, but we showed this chart on the run-up before the market rolled over, as at the end of July into early August, and noted that if the S&P was going to match these longest uptrends here, that we'd have to see the number of stocks making new highs continue to expand. And we can see here that we hit the high of 81 as, again, the market was moving higher, but that's still much lower than what we've seen, again, during the best run-ups here, where it got to, close to 200 numerous times, including, of course, the spike in early 2021. And so, seeing that again get to the mid 100s on an eventual breakout would be normal from this perspective. And again, eventually we want to see that. We don't need to see it right away, but if we're going to go much higher, that is a component that we'd like to see actually happen. Now, looking at new lows, the numbers remain subdued here, but not existent. Getting into the 20s recently. Now, that's a lot different to what we saw from 2020, 2021 to remain in the single digits, close to zero most of the time. Now, that's an aberration because we know what happened in COVID. So many stocks, over 300 made new lows. And so because of that, so many stocks still remain above those lows for many months until, of course, the end of 2021. Now, looking at the prior bullish years, There were actually periods when the number of new lows increased even more than this. We saw that in from late 2017 to early 2018, but I think even more interesting is 2019, considering how similar the year has been so far. So back in 2000 or in August 2019, we saw as many as 51 stocks here, right? Saw a similar amount in May, but August was interesting because considering we're close to that period again now. And so 51 stocks at new lows. That's a lot. And remember, there were a number of big 2% down moves that month as well. So it looked iffy coming out of it. But what happened? It didn't kill the uptrend, continued to remain in play and getting through the volatility that followed, in August and September, more of the best fourth quarter rallies we've seen in history finally took hold, right? And so that is something that we're going to be potentially looking for happen again in 2023. But again, we have to get through a potentially tough period. Now, this is a chart from my friend Ryan Dietrich at Carson Group, puts out outstanding stats all the time, showing that going back to 1950, the period from September 20th through 30th is one of the worst stretches of the year. Again, going back many decades now. So the stats and charts, we discussed in a piece yesterday, show the same bias. We looked at the 20-year average path, which again shows a high being made typically in the middle of the month and then selling off. And so, the takeaway is that weakness in the second half of September is typical. Thus, if the market outperforms that average, it will be a constructive side heading into the fourth quarter. And that's what we'll be watching for the next 2 weeks. Thanks, and I'll talk to you soon.